Wow, this is completely crazy. Okay, let's just dive right into this because the news headlines surrounding this company are absolutely wild right now. On one side of our screens, we're seeing Joby Aviation pulling off these historic, first ever point-to-point electric air taxi flights directly over the Manhattan skyline. We're looking at a company commanding a massive valuation of roughly $10.2 billion. Everyone is treating this like the absolute next quantum leap in human transportation. Yet, at the exact same time, you pull up the stock chart and boom, the stock price is down roughly 30% in early 2026. So how does a company literally making aviation history see its stock get hammered like this? Is this just high-flying hype designed to trap retail investors, or is this a massive, data-backed buying opportunity hiding in plain sight? The data tells a very specific story here, and the stock's recent volatility actually isn't about those flashy test flights or the physical prototypes you see on the news. It is driven by three concrete, quantifiable factors that institutional investors are heavily pricing in right now. First, Joby has successfully flown its first FAA-conforming aircraft for type inspection authorization testing. That signals a critical shift from building a cool prototype to undergoing strict, unforgiving regulatory scrutiny. Second, they were officially selected for the White House-backed eVTOL Integration Pilot Program, or EIPP, to conduct real-world testing in up to 11 major states. And third, which is the anchor currently dragging down the stock price, there is a massive, aggressive cash burn rate of roughly $660 million over the past 4 quarters. That massive burn rate is absolutely required to fund this commercialization phase, but it makes the market incredibly nervous. Wait a minute, doctor. What exactly are they building, and what does this actually have to do with our stock accounts? You're throwing around all these heavy terms like FAA conforming and eVTOL, and that's just way too complicated for a Tuesday. Could you give a really simple elementary school level analogy for what Joby actually does? Because right now, all I see on the news is a giant, fancy drone flying over New York City. Think of Joby Aviation as the Uber of the skies. They are not just building a traditional helicopter or a plane to sell to airlines, they are building a quiet, all-electric vertical takeoff and landing aircraft that will completely bypass ground traffic. But more importantly for your stock account, the data shows they're pursuing a vertically integrated transportation as a service model. This means they intend to manufacture the aircraft themselves, build the consumer booking app themselves, and operate the daily passenger service themselves. It is a completely closed-loop ecosystem. Furthermore, Joby's CEO, Jobin has stated on the record that their ultimate goal is to make a ride in one of these aircraft cost the exact same as traditional ground transportation. Oh my gosh, really? So what you just said basically means they don't just want to sell planes, they literally want to replace my daily taxi commute with a flying electric drone that costs the exact same price. That is a massive ambition. Okay, so to figure out if this story actually ends with us making money, we need a strict roadmap. Here's our agenda for today's explainer. First, intro and raising the issue, which we just did. Second, we're doing a financial and fundamental deep dive. Third, we'll look at the industry environment and economic moat. And finally, stage 4, the 3 survival scenarios. Let's get into it. Moving right into stage 2, the financial and fundamental deep dive. Now, I am challenging you directly here. Let's stop looking at the Golden Gate Bridge flights and the Manhattan PR stunts. I want to look under the hood of that Q1 2026 earnings report. What is actually keeping the lights on at Joby right now? To understand Joby's actual survival timeline, we have to start by analyzing their liquidity. According to their first quarter 2026 financial results, Joby ended the quarter with a staggering $2.5 billion in cash, cash equivalents, and short-term investments. That $2.5 billion is their absolute most critical asset right now. It is their runway. Developing advanced aerospace technology and pushing it through the Federal Aviation Administration takes years of rigorous, expensive testing. Without a massive cash reserve, a pre-revenue aviation company will simply go bankrupt before they ever receive the final certification to fly paying customers. This $2.5 billion cash pile is exactly what allows them to absorb massive operating losses while they rapidly scale up their manufacturing capabilities in both California and Ohio. Okay, but we absolutely have to talk about those operating losses because I'm looking at these specific numbers on the income statement and they are literally making my eyes water. Break down this table for us because it looks rough.
The condensed statement of operations reveals exactly how capital-intensive this final push toward commercialization truly is. For the first quarter, Joby reported total revenue of just $24.2 million, which largely comes from early defense contracts and research grants. However, look at the expenses here. Their research and development costs alone were $177.4 million. When you factor in selling, general, and administrative costs to support the corporate structure, their total operating expenses for a single quarter hit an incredible $257.8 million. This ultimately resulted in a net loss of $110 million for Q1 alone.
Are you kidding me? They are making barely $24 million. So why is the market going completely wild when they are running a massive $110 million deficit in just 3 months? What does that have to do with our stock accounts if they are just setting $100 bills on fire?
The data proves they aren't setting money on fire. We are looking at the foundational cost of building vertical integration entirely from scratch. You cannot value Joby the way you value a traditional software company. At this pre-commercial stage, the $24 million in revenue is fundamentally negligible. What institutions are closely monitoring is the strategic cause behind that $257.8 million in operating expenses. Every single dollar spent right now is geared toward escaping the prototype phase and entering the mass production phase.
Okay, wait, explain that aggressive scale up to me. Why are they spending so much right now if they aren't even fully certified to fly everyday people yet?
We can clearly see the cause in the R&D trajectory. The R&D expenses jumped from $134 million in Q1 2025 to $177 million in Q1 2026. This increase is directly correlated to them actively scaling up their composites production to more than 2.5 times last year's volume. They currently have structural parts in active production for 8 additional conforming aircraft. Furthermore, they have aggressively expanded their manufacturing footprint in Ohio to nearly 1.5 million square feet. And they have initiated their first conforming propeller blade production line. The market understands that this massive cash burn is physically required to build out the factory infrastructure that will eventually be responsible for generating billions in future passenger revenue.
Okay, so what you just said basically means they have a huge war chest, but they are burning it incredibly fast to build giant factories and physical prototypes before they even have full permission to fly paying customers. That brings us to stage 3, industry, environment, and economic mode. Because if they are spending this much money, they better have an irreplaceable weapon against the competition. Let's look at it. Their irreplaceable weapon, or economic moat, is their decision to own the entire transportation as a service model. The urban air mobility market has massive global potential. Analysts at Morgan Stanley have previously projected it could become a $9 trillion market by 2050. To capture the highest profit margins within that market, Joby is operating vastly differently from its primary peers. Most competitors, such as Archer Aviation, Vertical Aerospace, or Embraer's Eve, operate on an original equipment manufacturer, or OEM model. They plan to build the aircraft and simply sell them to airlines or private operators, relying heavily on third-party aerospace suppliers for critical components. Joby, on the other hand, is building the aircraft and its unique components from scratch and intends to operate the ride-sharing network themselves. This go-it-alone strategy requires substantially more upfront capital, but it provides complete end-to-end control over the customer experience and the long-term operating economics. But doing literally everything alone sounds incredibly risky. Are they actually trying to conquer the sky entirely by themselves?
No, and this is where their strategic partnerships fortify their economic moat. They have secured massive, highly integrated commercial alliances to offset their operational risks. Toyota is providing critical, world-class manufacturing assistance to ensure automotive-level production efficiency. Uber Technologies is heavily involved, with concrete plans to integrate Joby's air taxis directly into the Uber ride-sharing app so users can book a flight as easily as a car. Delta Airlines is partnering with them to run seamless airport transfer operations in heavily congested key markets like New York and Los Angeles. And finally, the U.S. government selected Joby for the EIPP program. This acts as a regulatory sandbox, enabling real-world testing in up to 11 states and helping to streamline traditional approval processes.
Wow. Okay, so they have Toyota building the planes, Delta flying them to major airports, and Uber putting the booking button right on our phones. That is a serious ecosystem. But none of this actually matters if the government steps in and says no. Where exactly are they with the FAA right now?
The regulatory timeline is quantifiable based on their May 2026 certification update. The FAA type certification process involves 5 incredibly rigorous stages. Joby is currently 100% complete with Stage 1, which establishes the certification basis. They are 97% complete with Stage 2, defining the means of compliance. For Stage 3 certification plans, they are at 82% internally, with the FAA already accepting 75%. More critically, they just completed their SR3 audit with the FAA. This specific audit is a massive milestone because it confirms that Joby's internal test data and safety protocols meet the FAA's strict expectations as they head into the final, most difficult testing phases.
But what about the actual physical planes? I mean, we see these percentages on paper, but are they actually flying real hardware for the government right now?
We can see the visual proof right here. This is Joby's first FAA-conforming aircraft, tail number N547JX. This is no longer just a company prototype. It is built precisely to FAA-designated engineering representative-approved designs. It is currently undergoing Type Inspection Authorization, or TIA testing. This is the exact phase where Joby's internal test pilots conduct initial flights to pave the way for official FAA pilots to step into the cockpit. Once those FAA pilots take over, they will conduct the final rigorous flight validations required to clear this vehicle for commercial passenger service.
That sounds great, but I'm going to stop you right there. What if they price the tickets way too low to actually make a profit? Or what if that $2.5 billion simply runs out before the FAA finally says yes? I mean, you just said they burned through $660 million in the last 4 quarters alone.
You have just identified the exact fatal weaknesses that represent Joby's core execution risks. Joby's leadership wants to price these flights competitively with ground transportation to capture the mass market. However, for a highly capital-intensive business, low consumer pricing means razor-thin profit margins, especially in the early years. Furthermore, if certification gets delayed by even 1 or 2 years due to a failed test flight, a software glitch, or simple regulatory gridlock, that $2.5 billion will deplete rapidly. That would force them to raise more capital at terrible interest rates, heavily diluting current shareholder value.
So what you just said basically means this is a relentless race against the clock and their own bank account. This brings us perfectly to stage 4, 3 survival scenarios. Stop listing historical facts for a second, my friend. We need clear, actionable grounds for making actual investment decisions based on what happens next. Let's see the scenarios. Understood. When we logically analyze the current financial data, the broader macroeconomic conditions, and the regulatory pacing of the FAA, we can project 3 highly specific survival scenarios for Joby Aviation: a bull case, a base case, and a bear case. Let's break them down. All right, let's start with the best case scenario. What exactly needs to happen for this stock to be the millionaire maker everyone is hyping it up to be?
The bull case trigger requires absolute, flawless execution over the next 12 to 18 months. The FAA must approve commercial operations for a late 2026 or early 2027 launch, without handing down any unexpected, costly safety mandates. Simultaneously, the EIPP program must successfully facilitate early operations in those 11 designated states, penetrating mega markets like New York, Texas, and Florida. Furthermore, the software integrations with the Uber app and the physical integrations with Delta Airlines must scale rapidly from day one, immediately proving to Wall Street that mass consumer demand exists. If this happens, Joby captures the absolute lion's share of an eVTOL industry that analysts estimate could reach $28.6 billion by the end of this decade.
Okay, but let's be real here. Things rarely go perfectly when you are dealing with brand new aerospace engineering and government bureaucracy. What is the base case? The neutral, most likely reality we actually have to deal with? The base case recognizes that the market has already priced in a significant amount of future success, with the stock historically trading at high multiples of future revenue estimates. Therefore, the base case trigger assumes that certification moves steadily, but takes slightly longer than the company projected. Joby manages to get limited, highly publicized launches off the ground in friendly regulatory environments or localized routes, but they must carefully and strictly manage their $2.5 billion runway to survive the delays. In this neutral scenario, Joby remains highly volatile, acting as a narrative-driven story stock for several years as it slowly scales operations and attempts to prove its unit economics to skeptical analysts. And now for the absolute nightmare. What's the bear case? How do we lose our shirts on this investment?
The bear case trigger is a significant test failure or a fatal regulatory delay. If a conforming aircraft experiences a severe anomaly during TIA testing, or if the FAA abruptly changes safety mandates for electric propulsion, it completely stalls the commercialization timeline. Because their R&D expenses are consistently outpacing their negligible revenue, burning hundreds of millions of dollars a year, they will completely deplete their cash reserves before they ever reach scale. Even worse, if they do eventually launch but the CEO's low pricing strategy fails to cover the massive maintenance and battery replacement costs, they will fail to turn a profit, and the stock will inevitably collapse under the weight of its own operational expenses.
Wow. Okay, so basically, they have the world-class tech, They have the massive corporate partners, and they have a literal mountain of cash. But they are flying directly into a regulatory hurricane and just hoping their financial fuel doesn't run out before they land. To summarize this entire deep dive in one sentence using a famous quote from Benjamin Graham, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Right now, investors are passionately voting on the incredible story of flying taxis, but very, very soon, Joby is going to have to actually step on the scale and weigh some real profits.
That is a highly accurate assessment of the situation. The transition from a speculative story stock to a fundamentally sound, cash flow positive profit machine is the absolute ultimate test that Joby Aviation faces over the next 2 years.
Thank you for watching today's explainer. Your subscriptions, likes, and supportive comments are a huge encouragement for our channel and truly help us keep producing these deep dives for you. Don't forget to ring that notification bell so you never miss another analysis into the stocks that are quite literally shaping our future. So what do you think? Will Joby Aviation truly become the Uber of the skies, or will they become a multi-billion-dollar cautionary tale of flying just a little too close to the sun? Let us know what you think in the comments below. Stay curious, stay focused, and keep learning.